Welcome back to another show I'm putting together here for you. We're going to go over financing options for multifamily today. Real Estate Lab. Hey guys, so we're going to cut to a video that I've actually recorded before, and so I didn't want to double record it because I thought this was a really good video that I'd done in the past about financing options for multifamily real estate. I'm going to go in depth in all the different types of loans you can get, what they look like. The video is taken, I think, in like 2020, but it's still all the same type of information. The only thing that's probably different is interest rates, which are always changing, so I'm going to give you that preface. So check out the video. I'm going to cover all the different financing options for apartments. Hey everybody, I'm Dave Toupin. Welcome back to another show I'm putting together here for you. We're going to go over financing options for multifamily today, and that's really important for you guys to know and understand as you're getting into the industry. You have to know the options that are available for financing these properties, because most of us are not coming up with cash to pay the $1, $2, $3, $4, $10 million prices that we're paying for these properties. So, without further ado, we're going to jump in, blow up the screen, check it out. I'm going to start running you through some options here. So, I'm going to start on the smaller end with loan size under $1 million. And why I'm doing that and not going by unit size is because really loans change once you hit that $1 million mark. A lot of options open up once you're over $1 million. When you're under $1 million, there's significantly fewer options, and I'm going to explain why and what those terms are like. So there are a couple different loan types. You go to regional banks, local credit unions, or on larger properties you can go to Fannie Mae, Freddie Mac. These are government agency, government insured and backed loans. You can go to large private equity firms that do short-term bridge loans. They want to be in bigger size loans. The more they can lend, the more comfortable they are on giving better terms and lower interest rates. These small loans you're getting from local and regional banks, they're a lot more conservative because they don't have as big of portfolios and they're not insured and backed like the larger size loans are. So they're going to give you a little harsher terms, and I'm going to show you what those look like real quick. So if you're buying a property with a loan size under $1 million, you're going to have the following type of terms. So typically you're going to have a 70 to 75% max loan to value. So loan to value is essentially the amount of loan they're going to give you to the purchase price. If you have a $1 million purchase price and you have a 70% loan to value, they're going to loan you $700,000 is essentially what that means. So you're going to have to come up with a 30% down payment. Pretty typical. You're very rarely going to get above 75, and a lot of times they do stick to that 70. Some banks even are at 60 or 65. These are local banks, credit unions, and I'll point that out over here. Local/regional banks. Credit unions. Those are your most frequent providers of these types of loans under $1 million. Typically, you're going to have a 20 to 25 year amortization. And for those of you who do not know what amortization is, essentially it's a calculation that schedules out the breakdown of principal versus interest paid on each payment over the course of your loan. So if the term of the loan was the same as, there's two different things. There's amortization, which controls the amount of your payments and how much interest and principal. And then there's the term of your loan, which is how long are they going to lend you the money for and when do you need to pay it back. So essentially, if those two were the same time frame, amortization is the amount of time it would take you to pay off that loan. So in the beginning, you're going to be paying more interest and less principal. And then over time, you're going to be paying less interest and more principal and start to pay down your loan quicker. Principal is when you pay down your loan balance. So not to get too in depth, want to give you a quick explanation on that. So 20 to 25 year amortization, the longer the amortization, the better for people like us who are investing and want cash flow, because the longer it is, the lower our payments are. So that's how that goes. Typically, you're going to have a get this working again. You're going to have a 3 to 7 year term / balloon payment. 3 to 7 year term, 5 years is very common for these types of loans under $1 million. And that means that within a 5-year period, you have to pay off the loan in the form of either selling it, paying it off yourself, or you get another loan, refinance them out. Normally it's going to be the same type of loan, refinance them. Sometimes that bank will refinance it themselves. And why they do that is because they want to lock in a new interest rate. Let's say interest rates start going up over the next 5 years. They're going to want to have this loan at a lower interest rate end, refinance you with a new loan at a higher interest rate, so that they're earning more money on their capital that is lent out. So that's a common reason, and 3 to 7 years is pretty typical. Next up, we're going to have interest. So I would say there's 2 parts to this. Rates right now, as you can see, we're in 2019, end of 2019. Rates are in that 4.75 to 5.25% range for these types of loans. Sometimes they're a little lower, sometimes they're a little higher. I think it depends on the bank's appetite and risk level of the deal. And the strength of the sponsor and your relationship. So those are typically the kind of rates you're going to see. Not bad, but not great. And the next part is going to be what type of interest is it? Is it a fixed rate or is it a floating rate? And so a fixed rate means they're going to lock in fixed versus floating or variable. Sometimes they call it variable. And what that means is if it's a floating interest rate, they're going to give you a certain basis, and they follow the trend of, let's say, the 10-year treasury, which is a certain rate. And they're going to say you're 250 points over the 10-year treasury, and as the 10-year treasury changes, you're always 250 points above that, or wherever that is. So it's going to float along the way. It's good if interest rates are high and you expect them going down. It's bad if they're low and they might go up. So it's a risk to take. Sometimes if you do a floating interest rate, they'll give you a lower rate to start, but then you have risk of it going higher. And then sometimes, if you do a floating rate, they'll give you a more aggressive or a longer amortization or a longer term, right? So it's sometimes a negotiation, but I typically like to go with fixed rates because fixed rates give me certainty in where my payments are, and I don't have the risk of them potentially going up a lot higher. So that's a big factor in it, interest rates. Let's see. We've also got prepay or prepayment penalties. And prepayment penalties are common on all loans, and there's tons of different structures. These types of loans do not have as aggressive as some of the larger loans, so I think that's a positive on some of these local regional banks or credit unions. You're going to have a little bit more safe and less aggressive prepayment penalties. Normally it's going to be anywhere from 1 to 2% of the loan balance to prepay within first few years. And then a lot of times in the last year of the loan, there will be no prepayment penalty. So what they're doing is they're gonna get a penalty from you if you pay off the loan early, you refinance or sell early. They're gonna get a penalty to collect up for interest that they would have made if they held it longer. So that's essentially what that is. Prepayment penalties aren't too bad. Upfront fees, normally 0.75 to 1% of the loan amount. That's very common, right? So not too terrible. Let's erase that really quick. Not too terrible, but that's typically what you're gonna see. So those are the terms on smaller loans under $1 million. So let's dive in to loans over $1 million. And this is what we typically deal with, loans over $1 million. So you're gonna have a couple different options, and I am going to see if I can kind of lay out some sort of matrix here so that we can compare a few different types. We're gonna go with, let's go with agency loans, and then we'll also look at bridge or short-term debt. So, let's see, loan size. Let's look at loan size first, all right? That's gonna be the first thing we're gonna wanna look at. So, loan size or loan to value, it's gonna be for agency loans. So agency loans are stabilized loans. They're gonna want properties that are at least 88 or 90% occupied. They're gonna want for the past 3 months, right? So typically it has to have a stable history of good occupancy to qualify for an agency loan. They do not want risky deals. They don't want heavy rehab deals. They want deals that are stable, that are fairly predictable, larger properties, and there's a couple different types. So agency loans, you know, there's a Freddie Mac small balance loan, which is common if you're doing a $1 million to I think it goes up to $7.5 million. $1 to $7.5 million loan size. You're going to be in that Freddie Mac small balance loan. Those are great for the smaller properties. They're not too difficult to apply for. It's not too rigorous of a process. The reserves that they require are not as bad along the way. They're great loans to get for the smaller, stabilized properties. I love doing that type of loan. So if you're doing anything over, I think a $5 million loan, you're going to be looking more at Fannie Mae type of loans or Freddie Mac non-small balance loan. And those are both also great loan programs. I've done both of those. They're long amortizations, long terms, you know, 10 to 12 year terms, great interest rates, and those are perfect for those types of properties. The difference in bridge debt or short-term debt, construction financing, is they're going to give you much better loan to value because they're going to wrap in a lot of times they'll wrap in construction or renovation costs into the loan. However, you're going to have higher interest rates, shorter terms, and you're going to have just a couple different options. So I'm going to run through some of these standard terms that we're seeing on these types of loans nowadays. So agency loans, loan size or loan to value, really we're in that 75 to 80% range. And this is dictated, and this is something I forgot to mention, but the same thing with these smaller loans is we've got something called debt service coverage ratio. And a lot of times they call that DSCR, right? Debt service coverage ratio. And what that is they're going to look at what is the NOI of the property, the net operating income over debt payments, your debt payments, and that equation is going to throw out the DSCR number, and they're going to want, basically they're going to look at this and say, what is your NOI now, and what are the debt payments going to be, and what's that coverage ratio, and that's going to limit the amount they're going to lend to you based on those debt payments. So as long as you're covered under DSCR ratio, which normally these banks want to be at a 1.2 to 1.25 ratio, they'll lend you up to 75 or 80%. This is also this is also location dependent. Certain markets, they restrict loan to value because they don't like them or they're not as stable. They're more tertiary, so they're going to restrict the loan to value in those certain areas. So, I've done several loans where we've gotten 80% of purchase price with agency loans. So it's very common if you're in a good market, you've got a good deal. Bridge loans, they're going to do 70 to 80, sometimes 85% I'm just going to put 70 to 80% loan to cost, not just loan to value. And so they will take, let's say you're buying a property for $5 million, let's say $10 million, keep it easy. And actually, this is going to be even simpler. Let's say we're buying a property for $8 million and we've got a $2 million renovation. So that's a $10 million total project cost. Normally, you're going to be limited, if you're buying this deal, you're going to be limited, let's say, to 80% of $8 million for a loan, which is $6.4 million. With a bridge loan, it's short term and they're meant for heavier renovation deals. They're going to take sometimes 75 up to 80% of the cost. So let's say you've got an $8 million purchase price plus $2 million in renovations. Your total cost is $10 million. Even if you only have a loan to cost of 75%, you're getting $7.5 million instead of that 6.4 that we were seeing before. So those can be very beneficial in terms of getting a higher loan amount, and you're going to get higher leverage, higher return on your money, as long as it's a property that you can raise that value. You're not going to want to do that if you can't raise that value from 10 million up to 11, 12, 13 million. And so because you're not going to want to have that much debt on the property. So they're more for value add or light, medium, or heavy value add deals. You're going to do bridge loans. So that's it. Loan to value versus bridge loans. It's loan to cost a lot of times. So let's see. Next, we've got amortization. You're almost always 30 years with agency loans. It's very common. Sometimes they'll be 25 years. I've always gotten 30 years on agency loans, Fannie and Freddie type product. Very common. Bridge loans, you're going to be in 25. Let's see, you're going to be in that 25 to 30 year amortization. So not bad, but agency, you're almost always at that 30-year amortization. Okay, what else we got? We've got term, length. Normally agency loans, there's different options. You can go with a shorter term, which sometimes will give you a better interest rate, or you can go with a longer term, which will give you a little different or a little higher interest rate. It's kind of dependent. You can look up charts online, which will explain it better, but there are different options. Typically, we're getting 7 to 12 year loans with, I would say 10 is average, 10 being average, 10-year term. There are agency loans sometimes fully amortizing. And what that means is whatever the amortization is up here, that's the term length. So if you have a 30-year amortization, sometimes you can get a fixed rate for a 30-year term. So you don't have to prepay it for up to 30 years, which is awesome. That is incredible, especially if you get a really good interest rate. You're going to want to lock in for a long time. Some of the things with these terms is the longer the term, sometimes the more aggressive the prepayment penalties are up front. It all depends. I'll go through that in a minute. Bridge loans, you're going to be really in that 2 to 3 year length, 3 being the average, plus sometimes they have extensions. So a lot of times you'll be able to extend the loan. I've done a couple of these where we get a 3-year term. We can extend it twice for 1 year, so up to a total of 5 years, 2 1-year extensions, but you have to pay a point on the remaining loan balance, so 1% of the remaining loan balance for each extension. And you have to meet certain criteria, like certain occupancy criteria. You have to meet certain debt yield and debt coverage ratios, and if you meet all those, occupancy and whatnot, you can extend it, but you still have to pay a fee to do that. So that's one of the benefits, but also downfalls of bridge loans. You get higher loan to value. They wrap in construction costs, normally interest only, which I'll get into, but you have shorter terms, which is risky, and you're going to have a little higher interest rates. So speaking of that, let's get into interest rates. In terms of interest rates, agency loans right now, I mean, I heard of somebody the other day closed a HUD loan, which is a type of agency loan. It's more complex and less common, I'd say, for most investors, but a lot of very sophisticated investors use HUD loans, and they got a 3.6% interest rate, which is absolutely incredible. But I would say right now, agency loans are in that 4 to 4.5. You know, as of, let's say, you know, late 2019, we're in that 4 to 4.5% rate. And like I said, sometimes that depends on the structure you choose to go with. If you want to do a shorter term, like 7 years, they might give you a little bit better loan or better interest rate. Sometimes, you know, it's a little bit up for negotiation, not much, but those are the types of rates we're seeing right now, which are, I mean, this is phenomenal. 4 to 4.5%. That's a great rate. So, bridge or short-term debt, I just got a quote the other day, and we're seeing this is a pretty heavy value add, so it's a risky deal. It's not risky in terms of the bank's eyes. It's not a stabilized property by any means, and so I think we got quoted 6.5%. So for these, you're going to be anywhere from 6 to 6.5% on these types of loans. Sometimes higher, you know, sometimes 7% if you're doing hard money. Some of these will go up to 90% loan to cost, but they're going to have a 7, 7.5, or 8% interest rate. So this is pretty common though, the 6 to 6.5% for a bridge loan. These are, a lot of times, these are interest only. Interest only for the whole 2 to 3 year period. And then normally once you do the extensions, it starts amortizing, so you're paying principal and interest. This, we just say IO. Let me clean that up a little bit. We just call IO interest only. I would say anywhere from 2 to 4 years is common, and then it's amortized. I have seen and I have had quoted loans where you're up to 10 years interest only. Very possible. Depends on the strength of the borrower and the deal, but it is possible. I'm just writing down what's common. 2 to 4 years is pretty common on the interest only side. Okay, let's see. Prepayment penalties. So I'm going to keep these going down. Prepayment penalties. So, agency loans. It's very common to have, there's 2 different types. There's a step down, and there is what's called a yield maintenance. And I have asked lenders what yield maintenance is, and even they have a hard time describing it sometimes. But I'll tell you the difference, and you know, from my knowledge. So step down is going to be a prepayment penalty structure where it's fixed and you know what it is. And let's say you have, let's keep it simple, let's say you have a 5-year loan term. They're going to tell you up front that your prepayment penalties are, let's say, a 5, a 4, a 3, a 2, and a 1. And so that means in the first year, you're going to have a 5% of the remaining loan balance prepayment penalty. The second year, you're going to have a 4%, third year, 3%, and so on and so forth. And so sometimes, you know, I'll see these where it's like on a 10-year loan, you're going to have like a 5, 5, 4, 4, 3, 2, 2, 2, 1, 1, blah, blah, blah. And over the 10 years, you know exactly what your prepayment penalty is going to be, right? So that's pretty beneficial. Normally for doing a step down, you're going to have a little higher interest rate, might be 10 to 15 basis points different. So you know, you can sometimes choose that. I have been very glad that I've done step down in the past because I saved on what I would have had to pay if I did a yield maintenance and got a better interest rate, because yield maintenance is a method where they take the current, the interest rate that you have on the loan, They look at what are the interest rates today. Let's say a year after you get the loan, let's say you have a 4.5% interest rate. Interest rates have gone down to 4%. And then they're going to look at like the 10-year treasury, and they're going to look at other interest rate factors. And depending on where those rates are compared to what your rate is, they're going to have a calculation that calculates what your prepayment penalty is at the time. And it also depends on how many years you are into the deal and how much interest you paid so far. So yield maintenance gives you, like I said, a better rate up front. However, if you plan to sell this property within the first year or two, you're going to have a significant prepayment penalty depending on where interest rates are. But normally they haven't changed much in that short of a period, and so you're going to have a significant prepayment penalty, especially if rates go up, because if rates go down even further, I believe you're going to have an even higher interest rate or prepayment penalty. Don't quote me on that, but really it's just a factor of where the current rates are, where your rate is, how much interest you paid, and how much time you're into the deal. But if you plan on selling in the short term, yield maintenance is very difficult because you're going to have to pay extremely high. I mean, they could be 8, 9, 10, 11%. I've seen even higher, like 12 or 13, depending on how soon you try to sell it and pay off the loan. I've seen some crazy prepayment penalties. So that's that. Bridge or short-term debt, you're normally going to be in the 1 to 2% prepay. However, a lot of times they'll also do minimum interest, and they'll say, let's say for example, minimum 18. Let me erase that. Minimum 18-month interest. So if you sell, and I just did this earlier this year, we sold a property within 7 months, and we had to pay the 18-month minimum interest, which we knew going into the sale, and we calculated that. However, it was a huge prepayment penalty. It still made sense to sell, but just keep that in mind. That is something that they're going to have. After that 18 months, it's really normally just 1 to 2% to prepay. Whereas on something like an agency loan, you might still be at a 4 or 5% rate after a year or two prepayment penalty, or yield maintenance, which is going to be even higher. So bridge loans are really good if you plan on getting in, renovating, and refinancing within a couple years. So that's what those are for. Let's see. Let's keep this going down. We've got upfront fees. Normally, this is going to be 1%. I mean, you might be 0.75 to 1% on these, and then you're going to be anywhere from, point over here. It's pretty common, 0.75 to 1.5%. I'd say 1% is the average. And same over here, 1% is pretty much the average. So, pretty common. The cool thing about agency loans is a lot of times, are they assumable, which is a cool factor. So assumable means somebody can step in, buy the property from you. Let's say you have an $8 million loan and you're selling for $11 million. They're going to pay you the $3 million down payment, the difference between the loan and that. They're going to assume your loan and just take over your loan at your terms, and then operate the property going forward with your loan in place. So it's really beneficial. For example, let's say I bought a property and I locked in a loan at 4%. A year later, I go to sell it and I have a huge yield maintenance penalty or a big step down prepayment penalty. So I'm going to sell it to somebody who can assume the loan, and they're going to take over my loan. And let's say the rates are at 5% now. So they're going to get a loan which might not be as big of a loan amount as they might be able to get based on the new purchase price, but they're going to be at a 4% interest rate. I'm going to be able to sell it for a better price because I don't have to pay this huge prepayment penalty that cuts into my profits. And so they'll take over, they'll assume it, and they'll operate it. No prepayment penalty if someone assumes it. Sometimes there might be like a 1% fee from the buyer to assume it. However, I don't have to pay my yield maintenance, and then they can take over at a better interest rate. So It's really good to sell on an assumption basis if your interest rate is a lot lower and you have a good loan amount compared to what interest rates are at the time where you're selling it. So that's beneficial. So I'm going to say yes, assumable. Bridge loans are normally, I'm just going to say no, they're not assumable. There are probably scenarios where they are, but it's very rare you're going to do that for a loan that's only a 3-year term. These make sense to assume because you might have a 10, 12-year term and you're selling it at year 2. They're going to assume it and still have 8 years left. So very common for those to be assumable. These loans, I'm just going to say not commonly assumable. And they might be, but I haven't run into that scenario yet. So I guess I'll start a second back. I'm only explaining these loans to you guys because I've done at least one of each type of these. I've done bridge loans, I've done multiple agency loans, Freddie Mac small balance, I've done Fannie, I've done regular Freddie loans. I have done several regional bank loans with smaller local banks. So these are the terms that I commonly see, and they're pretty updated to today's time in late 2019. However, they might change. They're always changing and evolving. Interest rates are changing every day. So just talk to a loan broker if you're looking to get the updated and current terms. However, I just wanted to give you guys a breakdown of what I'm seeing in the market, and hopefully this helps when you're going into underwriting and looking at deals. It's very important for you to know the types of loans that you can get, the types of terms, interest rates, amortizations, and loan to values you're going to see. Hopefully that helps you guys out. I will catch you on the next video. Make sure to comment, like, subscribe to my YouTube, follow me on Instagram at Real Estate Jedi, and I will see you next time.